Hello and welcome to Bazaar Morning Call. I am Prashant, and with me my colleagues Sonia and Nigel. And only one of us is dressed in the appropriate color today, which is Sonia. I mean, it's looking deep red, and it's going to be a lower start, no doubt about it. I mean, so unless you've got your head in the sand somewhere, it's pretty out there what has happened. The US CPI number came in hot. I mean, much hotter than what anyone really expected. And it's kind of questioned the notion that US inflation is moderating, which has been this narrative that eventually things are slowing down faster than expected. The data does not say so. This data point creates challenges for the Fed, which means that it's a challenge for the market as well. As a result of which, US indices saw very large declines. I mean, this is not to be scoffed at, 5%. I mean, in the whole of last week, the S&P went up 4%. In a single day, it's given up all of that. 4 on the S&P, the Nasdaq down 5, and the SGX this morning is indicating, a lower start by about 300 points or so, 17,776. India has been the best performing market. It's got the strength, it's got the relative strength, it's got the outperformance, but it also means that it's one of those few markets which has got some gains to give back as well. Yeah. Guys, hi.
Hi, morning Prashant, morning Nigel. It's all on the screen, right? I mean, it has been the worst day yesterday in the US market since June of 2020. So we're looking at a severe cut. And of course, for our own markets as well, the start will be well in the red, as the SGX is suggesting. Now, in the CPI data, what I think spooked the market this time around is the fact that despite a drop that we saw in gas prices, inflation rose 8.3% on a year-on-year basis. Now, that has sparked some sort of fears that perhaps the rate hike by the Fed could be more than 75 basis points on the 21st of September. And that's the only reason why most global asset classes have seen a sell-off. But for our own markets, it's been so resilient. So the big question really is, will the dips get bought? Because that's been the case so far. There's so much momentum in our markets. FIIs have bought once again almost 2,000 crores. So that's 3 days running of almost 2,000 crores plus of buying by FIIs. And in the last 8 trading sessions, relentless money coming in, almost 8,000 crores from FIIs. So, of course, DIs have sold a bit, about 1,270 crores or so. The big question really is, there is this FOMO feeling in the market, right, in the Indian market, and we've sort of decoupled from global peers. Will there be a buy on dips? Maybe not at opening. Opening, of course, it's going to be a gap down. But then, will people look for opportunities?
Yeah, that's a big question for short-term traders, etc., Sonia. No, absolutely. But I think, this data point last night is a bit of a game changer, at least in the short term. And I'll tell you why. The narrative has been that with oil prices which have come off, gas prices which have cooled off quite a bit, I mean, prices at the pump, etc., in the US which have come off, inflation is no longer a problem. And hence, the Fed will kind of not take it easy, but it'll do what it is saying it has to do. And then by 2023, next year, things will be back to some kind of normal scenario. What this tells you is that inflation perhaps is much more entrenched. You look at services inflation, which is a problem, which is harder to get rid of, which is very, very hot. Even goods inflation is not seeing any significant step down. So I think that in that sense is a problem. So there are two reasons. One, the reason I'm saying this is a game changer in the short run, this data clearly ends the equity relief rally and the dollar decline. I mean, the dollar is perhaps, most were of the view that the dollar will go higher, but there is this near-term correction. But that's kind of immediately reversed after last night. So that's one. And second, it also, in a way, puts to bed some of this optimism that eventually we'll have a soft landing. We've heard from so many people. The reason why this is so, because if inflation is much more entrenched and we are not seeing any compelling evidence, as the Fed has called it, that inflation is slowing, then they'll have to do a lot more. I mean, the dot plot from the Fed put the Fed funds rate at the end of this year at 3.4. It's not going to be that. It's going to be perhaps much higher. So if the Fed's got to do a lot more, they can't avoid doing some more damage to the economy. So the soft landing scenario perhaps also comes under some question. So those are the two reasons. What happens from here? Remember, the Fed is in a quiet period. We get the Fed decision on the 21st. So markets will watch for any authoritative media reports. I mean, Wall Street Journal, etc., which, by the way, earlier on have reported on what the Fed is thinking, etc., and the market takes it very seriously. So that perhaps is something which we will watch out for. A reportage on that particular front. While 75 basis point is priced in, I mean, what the data does is it also opens up the risk of 100 basis points. You can no longer rule it. By the way, market pricing of what the Fed will do through September, November and December, that moved up by 28 basis points in a single day. I mean, that's massive. And Fed funds rate is now priced by the market at 4.2%. The dot plot is at 3.4. So that's, again, quite significant. The dollar rose. That's one of the channels through which emerging markets get hit. The dollar index rose 1.5%. It's the largest one-day move since March of 2020. And this is what I began by saying. I mean, the Nifty has been by far the strongest market in the world. But it also means that it's got gains to give back, unlike other markets which never really saw any meaningful, any significant bounce in that sense. I mean, the Nifty is up 5% in the last 10 trading sessions. The flows data, which Sonia pointed out, is important. We've been getting this chunky amount of money day on day. I suspect, you know, some of it is basically just allocation to India in the absence of any other emerging market. And we presented this data in detail, how MSCI, the emerging market as a basket, has got little by way of options. I mean, China, there's Taiwan, there's South Korea, and each of them have got problems. So in that sense, this chunky 2,000 crores which we've been getting for the last many days, perhaps could be allocation to India. So if that is a certain amount of money has to come to India for XYZ reasons, I mean, that may still come in and that may support the market. But if you're a trader, and if you especially have made money, I mean, I think the instinct should be to protect the profits and not jump in to buy the dip aggressively, at least, you know, at the word go. Wait it out. I mean, it's not as if things are going to change dramatically over the next couple of days. We won't get any new information. The Fed is in a blackout period, at least till the 21st, which is the Fed meeting. You know, you let things settle and then decide what to do. Nigel.
Well, morning, guys. You know, as you said, Prashant, things are likely to be a little bit sketchy, at least for the next 1 week or so, till we confirm like what's going to happen from the Fed. But in terms of flows, everyone's focusing on the FI flows. But the DI outflows, well, that's perked up a little bit. And from around 700, 800 crores odd, yesterday we had a number of close to 1,300 crores odd. And that's the highest we've seen in the last 1 month or so. So just keep an eye out on the DI net outflow number as well. On index futures, yesterday there was big short covering. 25,000 short contracts were covered out. The FI short positioning now is at around the 65% odd. Remember, just a week or so ago, we were at around 80% odd. So a lot of that short covering has taken place. Not just that, the net short positions. I'm talking about the FI shorts minus the FI longs. In terms of contracts, that's come down to around 35,000 contracts from around 85,000 contracts in the past week or so. What's encouraging for me, though, is that put writing continues. And today is going to be a test for the bulls. The PCR has moved to around that 1.4 odd mark, so it's moving towards the higher, towards that 1.5, 1.6 odd level. How do you approach trade today? My guess is that, in fact, if that 17,650 to around 17,700 mark, if that range holds out, then the bulls will feel they are in with a chance. For the time being, the SGX Nifty is indicating a gap down of close to 300 points. So we do get that 325, 330 point downtick. I think, you know, risk reward could favor a bullish trade. Why is that? Because you have a stop loss at around the 20 DMA. And maximum you lose is around 60, 70 points or thereabouts. So if you get that big gap down, then maybe risk reward could favor the bulls. Obviously, resistance will be yesterday's high. But let's wait by to see. The 20 DMA becomes a crucial support mark. And the bulls are in for a test. All that talk of decoupling, etc. Let's see whether or not it does play out today. But from a trading point of view, when you get a gap down, maybe in fact you could buy the Nifty.
And that's been the case, right? For so many days. I mean, every dip that has gotten bought has been rewarded.
Yeah.
So perhaps I'm not in the right color after all. Let's see through the course
Or maybe
of the
you're
day.
the only one who gets it right.
Well, let's see. Won't have to wait too long. But for the sake of the bulls, of course, it's been a uptrending market. Everyone's talking of an early Diwali. So don't want to dampen that enthusiasm. Of course, for early morning trade, there is a gap down coming. No two ways about that. But let's kickstart the show on the equities front. First up, we have Aichi Amemiya of Nomura, who says that materializing upside inflation risks are likely to result in the Fed raising rates by 100 basis points at the September FOMC meeting, above their previous forecast of 75 basis points. Beyond September, they continue to expect a 50 basis points hike in November, but now anticipate another 50 basis points hike in December, a 25 basis points higher than their previous forecast. So with their February 2023 expectations of a 25 basis points hike unchanged, their terminal rate forecast now stands at 4.5% to 4.75%, which is 50 basis points higher. All right. So most economists are now raising their expectations. Even in the September policy, there's an expectation of 100 basis points hike now.
Oh, this may change things for the RBI as well, right?
Yeah.
Because the RBI policy meeting is after the Fed, I think 26th, 27th or so. So last time also we had, I mean, if you remember, there was the RBI and then the Fed immediately after, and RBI hiked rates in anticipation. Some said in anticipation what the Fed will do. Well, we'll see. Here's some more sort of perspective. This is from the rupee markets. We have Kunal Sudani of Shinhan Bank, who says that U.S. core inflation came in almost double than expectations. Stock market slid while U.S. 10-year yield and dollar index bounced sharply, anticipating bets for more aggressive Fed rate hikes. Rising yields also revived recession woes for the dollar INR. 79.45 will act as a support, while 79.95 is a resistance.
Well, we have a lot of stock-specific action as well. Today, we'll get to that in just a bit in our top 10 segment. We're looking at Adani Ports, Hudson Agro, KEC International, HDFC Life, Ami Organics, and Ambuja Cements. Well, those stocks are likely to open up in the green or relatively outperform the market. While, you have a few more names, SBI, IndusInd Bank, AU Small Finance Bank, and Bank of Baroda. Well, some of the stocks could open in the red.
All right, well, back to the big global data point, the U.S. inflation number, which came in higher than expected, and it's kind of dashed hopes that the Fed will be less aggressive. Here is some important opinion coming in on it. Let's listen in.
We've actually had a lot more inflation over the last 18 months than recorded in the official statistics. And we're going to show a lot more inflation next 18 months, and there actually is going to happen. And the reason is specifically housing. My feeling is that, if they see the slowdown, if they take a correct view on what future inflation is, they may not have to go that high. That's the relief the market is watching.
Well, I think the markets are down to today for three reasons, and that's worries over recession, valuation, and Q3 earnings. So first of all, with the Fed tightening even more than expected, perhaps 100 basis points coming up, what does that mean for the future depth of a recession, which we do think will hit? We think the U.S. dollar remains strong because even with all of this going on around the world, the U.S. has been a safe haven because our economy and its resiliency is good for the dollar. And that also is what's giving the Fed the leeway to keep raising rates. They have been clear. They're going to continue to battle inflation. We see it remains hot, and that could happen at the expense of the economy. And with employment staying strong and consumer strong, it gives them the ability to keep raising rates in order to finally squash that inflation.
I don't think anything surprises me with inflation data anymore. It's hard to predict. I think the Fed hasn't got it right. The street really hasn't got it right. A few people were calling for big inflation last year and did get it right, but really, I think we're all flying a little bit blind. The one thing we do know, Sarah, and this is the important thing, is the Fed is really interested in kiboshing inflation, and they're going to keep going, and they're not going to declare victory early. And I think the market keeps getting ahead of itself and thinking that this Fed pivot is somehow just around the corner. And they're telling you it's not there, but the market just wants to believe it and gets itself all, excited, and then a little disappointment comes in and you get a day like today.
I think we'll retest the lows of June. I don't, for a simple reason that stocks bottom as inflation peaks. And I think July was the peak number. It's not coming down very fast, but it is coming down. I think they're going to raise rates by 75 basis points. Look, I think to a certain extent they're a little embarrassed because inflation has turned out to be a lot more persistent than what they argued last year. So I don't think they're going to raise 25. I think they're going to be a lot more aggressive than that and make sure they don't make the mistake on a second mistake.
All right, so lots of varied opinion. Arvind Sanger is now joining us, managing partner, Geosphere Capital Management. And it's a good day to have you with us, Arvind. You've been, from what I remember at least, I don't know if you changed your view in between. It's been a while since we spoke, so good to speak to you again. You've been pretty clear that this is not a problem which is going to go away quickly, and it will take a toll on markets. I mean, the rally here has been absolutely stunning, isn't it? It puts us right at number one pole position in terms of rankings for the year, return-wise. What does this inflation number do for prospects here in India specifically, in your opinion?
Well, I mean, we have to also look at inflation in India, right? So the global sell-off and the dollar strength is going to drive some outflows out of India as well, out of other, emerging markets and risk assets. So that, is coming. But the reason India has been, a relative outperformer amongst most major emerging markets and most major global markets is because the underpinnings of growth have been better. Inflation has been somewhat more muted compared to what it is, in many developed countries in the West. So, the inflation data that came out from India was slightly above expectations, 7% versus 6.9 expectations. I think the real question, again, for all global economies is what is the trajectory of inflation and what is the trajectory of growth? And if the inflation in India can remain on a downward path, which it hasn't clearly demonstrated that it is, and RBI doesn't have to slam on the brakes as hard as we are seeing Fed having to slam on the brakes, then India can continue to be an outperformer. But the real challenge is going to be if Indian inflation stays stickily high, then RBI cannot afford to be dovish and let inflation expectation get unanchored. So, in a sense, my view is that India has better growth trajectory, but the inflation trajectory, I am less clear on where India is going. I've been much more, cautious on inflation magically not disappearing. That's been my view. In the West, India, I'm a little less certain now.
Arvind, good morning and thanks for being with us. It's been a smooth ride, right, for the Indian markets. I mean, it's a 15% rally that we've seen in the last 3 months alone. And as you said, not just inflation, which has been under control up until now, but corporate profitability is also improving. The profit to GDP ratio is now at a decadal high. Would you buy the dip, even if there is a dip through the course of the next couple of weeks? Should the dips continue to be bought in a market like India?
I think so, provided that there is no significant deterioration in global fundamentals. India is in a sweet spot. It has the benefit from all the resourcing or friendshoring or whatever term that is driving growth. India itself has a resilience after having had multiple years of different headwinds. So Indian economy, I think, is in a good shape. And so, yes, the earnings are reflective of that. And that's one thing that I've been very clear about. Indian economic growth and Indian earnings growth is probably one of the brighter spots in the world. And so I think that, yes, we are more inclined to look at dips as a buying opportunity than panicking here. Although, we have to watch the currency, but I do believe that if Indian inflation, I can't remember the last time you had persistent 3-4 months of Indian inflation running below U.S. inflation. I mean, that's almost unheard of. So I think we have some tailwinds which provide, even on the currency front, some support that this is not going to be, from this $79, $80 level. There's not a huge downside if the inflation differentials stay in India's favor, which again is almost unheard of.
Morning, Arvind. Two-part question. Arvind, are you in the camp that believes that the Fed will do more than 75 basis points, maybe 100 basis points? Do you believe that? And the second fact is, do you believe that the June 2022 lows, they will hold out? The global markets have made lows for, for the year at least.
On the first one, I have a more clear picture, and I would say that I think it's unlikely the Fed is going to panic and suddenly go to 100 basis points. I think inflation, is coming down. It's coming down slower than they would have hoped. But I think they may do, 2 or 3 75s rather than do 100. So my bet is on 75. But, we'll find out soon enough. But my bet would be 75. I'm sorry, can you repeat the other question?
Have the lows for global equities that we saw June 2022, is that likely to hold out, or do you believe we could revisit that at some point of time if the Fed is very hawkish, growth slows down? Your take.
Yeah, I think that's a trickier one. That's a trickier one because it depends on how hard they have to slam on the brakes. And, if they have to slam on the brakes repeatedly hard and the economy is going to go into a, recession, earnings are, going to come down sharply and it's going to be 2 or 3 quarters of earnings weakness, then it's very hard to say that the market could have discarded all that in June. And therefore, that's the trickier one, in my opinion. It's kind of data dependent. It's how much they have to do, how persistent the inflation is going to remain. And, let's keep in mind, for the U.S., for the rest of the world, one of the big positives on the inflation front is China's zero COVID strategy and its slowdown, which has helped moderate inflation in the rest of the world. Because if China was going, commodity prices would not be as benign as they are, and that would add fuel to the fire. So let's take a case why this could turn out worse. If China, after President Xi gets his next 5-year term, starts reaccelerating, does that cause inflation globally to perk up, and that requires more of a slapping on the brakes? So that's why there are too many factors that are unknown to be able to say that June was definitely the low. So we'll watch the data and try to be a little more careful on that, getting too convinced one way or the other.
Arvind, companies that we speak with here locally, there's a general feeling of optimism about, earnings growth sustaining, even picking up, except maybe, entry-level segments across sectors doing a little poorly. But overall, it's more optimism than anything else. Investors that we speak with who are meeting companies, just the overall feedback is quite positive. Do you think the flows that we're seeing, these foreign flows, chunky amounts every day now, this is backing some of that? Or do you think this is, if you've heard anything of that sort, some sort of specific allocation for India because of all of the outflows we've seen, which were because of emerging markets as an asset class suffering? So this is some dedicated inflow for a market like India. What's happening in your opinion?
Well, there are two different factors at play. One is risk on, and the other is India relative. On the risk on front, you've had risk on for the last couple of months, and that has meant money getting allocated to emerging markets. And in terms of relative on emerging markets, India is clearly one of the best positioned. You have Brazil with an election with a lot of uncertainty, how the acceptance of that election results will go. You have Russia, which is uninvestable. You have China, which has made itself uninvestable. So you have, major emerging markets which are under a cloud, and India is one of the few bright spots where earnings growth has got some legs, and you don't have, some of the other risks around politics and around geopolitics. Therefore, yes, India will remain a bastion, in my opinion, of attracting foreign capital. I think, you may see a temporary outflow because of risk off, because of what, is going on with inflation and what the Fed might be forced to do. But I wouldn't worry too much about it. This is not like what it was in 6 months ago, where there was continuous outflows, India and other emerging markets. I think that shock is largely behind us, but there will be ebbs and flows. But I think India will be a relative winner.
Okay, just one final question. We've been seeing this market be led by financials, right, up until now. IT has not done too well. In fact, most of these large cap IT stocks are under a lot of pressure. But now there's a narrative that perhaps the worst of the margin pressures is behind these IT companies. In fact, TCS mentioned that at a recent analyst meet as well. Is this a time to load up on IT?
Well, I think IT has had two headwinds. Obviously, one is the margins were unusually good when there was no travel and a lot of other stuff that helped margins. So there's been a little bit of a margin pullback. Wage pressures, are probably rising, as well as staff attrition. But I think the other question is how much of a recession, if the West has, certainly the U.S., which is the most important market for IT companies in India, how much will that affect? So I'm not sure that IT is the best place, because at the end of the day, IT has an angle of Western growth and economic sensitivity at some end thrown in. So I think IT stocks have gotten cheap, but let's be a little more cautious about how much does the U.S. economy slow down. That's the only remaining headwind. The other headwinds, I think, are largely discounted in the IT stocks.
Well, the color is red this morning. The SGX Nifty is down over 350 points. Okay, 320 points now, indicating that the start will be deep in the red on account of that red-hot inflation number that came out in the U.S. and the expectation that there would be a bigger rate hike than earlier anticipated. But let's talk about individual stocks in our own markets. Ambuja Cements is in focus on account of possible fundraising. Nigel has more. Nigel.
Well, Sonia, the stock has been moving just in one direction, that's upward. Yesterday as well, it ended at the high point of the day. And late last night, they came out with an disclosure on the exchanges that they're going to be meeting. There's going to be a board meet on September 16th, and they'll be considering and evaluating proposal for fundraising. They're saying it could be via various instruments, whether it's equity, convertibles, other instruments as well. Now, details on this fundraising will be awaited because the street will be waiting by whether or not it's for organic growth or is there some big organic growth that they're looking at. That's something that the street will be speculating on. And if they're going to be raising money via issue of shares, will it be to the promoter group? Are they looking to bring in a partner, or is it some fund, another fund that they are looking at? So details of this fundraising will be very, very crucially looked at. Let's see what comes out of it. But the stock could be a relative outperformer, as has been the case for the last 1 month or so.
All right. We'll keep an eye. Ambuja Cements in focus. Nigel, thanks very much for that. Now, State Bank of India, IndusInd, and a bunch of other financial institutions in focus. There have been management meetings with brokers. Lots of opinion coming through. Abhishek is here with a compilation. Abhishek, morning.
Morning, Prashant. So there was a Morgan Stanley conference wherein all the lenders that you mentioned were present. And the key takeaways, let's begin with SBI, wherein Morgan Stanley has an overweight rating and a target price of 675 per share. Over there, the key takeaway is that the loan growth momentum remains strong. They expect the margins to improve from Q2 FY23 onwards, asset quality to remain benign, and digital initiatives will gain strong traction in the coming quarters. So cost to income ratio, or the operating efficiency that we call in banking sector, will improve over the next few years. They also had IndusInd Bank at the conference. Over there, the target price is 1,400 with an overweight rating. The key initiative again being, growth visibility continues to improve. Deposit has seen strong traction, growing at 18 to 20% YOY, aided by strong traction in new initiatives they have taken on the deposit franchise of the bank. So margins should remain stable despite rising interest rate scenario that we have, and slippages should moderate, which means the credit cost would be around 120 to 150 basis point range for the whole year. AU Small Finance Bank was also at the conference. They have an overweight rating over there with a target price of 875 per share. They say that the key takeaway in the conference from AU was that growth momentum sustained despite higher rates, margins to remain stable here on, and asset quality trends to hold up being benign. Bob, or Bank of Baroda, was the other management. They have an overweight rating with a target price of 170. Bob has mentioned that, net interest margin will improve by 15 to 20 basis point in FY23. Loan growth will be in lower single digits. Asset quality trends to remain strong, and they are looking to subsidize some of their subsidiary stakes. Back to you.
Okay, thanks a lot for that. So that's on the banks. Optimistic news coming in there from Morgan Stanley. But let's move on to speak to Mangalam about Adani Ports and why he's tracking that one. Mangalam, over to you.
Well, I'm looking at Adani Ports as a place of relative strength in today's trading session because the management also met the analysts at Jefferies, and Jefferies came out impressed with it. They've raised their target price from 850 rupees to about 1100 odd rupees, and that's because they've upped their volume estimates for the next 2 years by 3 to 7%, and that has resulted in an EPS estimate being up by anywhere between 5 to 11%. Why is it that they've done that? Well, because one, the management has said that they will benefit from gradual volume recovery as global container rates have eased, and also they're growing in logistics as well as warehousing to offer customers end-to-end solutions. But more importantly, from a medium-term standpoint, double-digit volume growth will continue for them, and that's primarily because the company will replicate what it did in Mundra to gain market share at all the ports that all the acquired ports that the company's brought into its fold. And finally, the international foray that Adani Ports is looking at will not be at the cost of returns, will only be return accretive. So with all these things, the management has managed to impress the analysts at Jefferies, and they've upped their target price.
Got it. Mangalam, thanks a lot for giving us a quick update. Let's hop across to Vivek. He's joining in to tell us about some other stocks that are in news. Morning, Vivek.
Well, good morning. 4 stocks on the radar. The first one is Hudson Agro. The company has told the exchanges that they have a board meeting scheduled on 19th of September to consider fundraising via the rights issue. So watch out for this particular name. The other one, of course, is KEC International. The company has updated the exchanges about a whole host of order wins that they've got in various segments that they operate in. So new orders worth a little over 1,100 crores is what they've received. Now, a couple of very interesting block deals to keep on the radar. The first one, of course, is HDFC Life. Like we highlighted whole of yesterday, Aberdeen has sold close to 2% stake. Now they have around 1.66% stake left in this particular company. Very interesting. Whole host of long-only funds, insurance companies, as well as domestic mutual funds have picked up significant chunks. Some of the larger names being SBI Life Insurance, Nippon India Mutual Fund, Morgan Stanley, and BofA Securities Europe. So watch out for this particular name. Lastly, a smaller name, Amy Organics, not much discussed, but this particular name, there was a significant block deal yesterday. Promoters sold a significant chunk, but what has actually attracted quite a bit of market chatter is the fact that the small cap world fund Capital International has picked up a very significant stake, along with Plutus Wealth Management. So keep these stocks on the radar, could be relative outperformers.
Okay, thanks a lot for that. That's a pretty long list there. In case you missed out on any of them, here's a quick recap of our top stocks. Stocks with positive news flow, there's Adani Ports, Hatsun Agro, KEC International, HDFC Life, Ami Organics and Ambuja Cements. While stocks with negative news flow this morning, SBI, IndusInd Bank, AU Small Finance Bank and Bank of Baroda. But all eyes will be on what's happening in the world of commodities. There's been a slight dip in crude on account of the global sell-off. Manisha Gupta is here to give us a quick roundup of all the action there. Manisha, good morning.
Morning, and thank you for that, Sonia. Well, yes, we started with a dip, but that really seems to be getting bought right now, while the markets on one side are dealing with the hotter than expected U.S. inflation. But on the other side, the OPEC has reiterated that the demand forecast for this year and the next year is going to be on the higher side. So 3.1 million barrels per day of a demand growth is expected this year, and 2.7 million barrels per day over and above that in the next year is what OPEC has posted. That has brought both the crude varieties in the positive right now on your screens. Apart from that, the U.S. emergency oil reserves also are at the lowest since October 1984, and that seems to be supporting prices as well. We did start the base metals on a weaker side as well. The strength in U.S. dollar continues to weigh here, and so does the higher U.S. inflation numbers. But that also seems to be getting bought into right now. So after that knee-jerk reaction and then immediate sell-off, there is some buying opportunities that you have seen come back across board.
All right, Manisha, thanks very much for that. So that's commodities in focus. But I think, it's going to be, let's just look at the SGX once again as we inch closer, 30 minutes away from the pre-open session, still showing about a 300-odd point cut. Take a quick look at what the rest of Asia is doing. The market here has the global setup for the last at least fortnight or so has not made too much of a difference. More than that, actually, at all. The market's kind of marched on irrespective. As I said, 5% in the last 10 sessions. But will this data point change things maybe at the margin a little bit? Hang Seng is down 2.5. The Taiwanese index is down 1.6. So these are meaningful cuts, but not really a blowout numbers on your screen. So lower start, and then we'll kind of pick up from there. We'll take a very quick break here. We'll speak with Nishal Maheshwari of Centrum Broking on some fundamental stock analysis, what he's watching. And of course, later we'll also have Srinivas Reddy of MTAR Technologies to talk about how the company plans to benefit or plans to utilize the government's defense.
Welcome back to Bazaar Morning Call. Well, this morning is going to be a slightly ugly picture if you're a bull, but we've been having a smooth run up until now. Nishal Maheshwari, Chief Executive Officer, Institutional Equities and Advisory at Centrum Broking, joins us now to talk about that. Nishal, good morning. I wanted your thoughts on, the discussion we were having with the previous guest on the IT space. Most of these IT stocks are down 20-30%, but now the commentary is indicating that perhaps the worst of the margin pressure is behind them. Would you buy any of the IT majors now?
Morning, Sonia. I have been positive on IT for, I think, a couple of months now, basically, because two things. One, obviously, the margin pressure was basically because they had very high attrition rates. And in the last quarter, I think most of the companies said that the peak of the attrition has happened at 27-28%. So a margin should have actually bottomed out last quarter. So I think margins seems to be bottoming out. Are they going up? I don't think so at the moment, basically, because I think the pressure from the from the sales will also come to have a problem for them. So yes, the margins are bottoming out, and at this point of time, we like all the large cap stocks basically out there, Tech Mahindra, HCL Tech, and Infosys in that order.
Hi, Nishal. Morning. What about Ambuja Cements? It's moving just one way, upwards. What's your take on it? You know, the open offer price was at around 385 odd. The stock is at 485. All this in a matter of a month. Now they're talking about raising some money. Would you still bet on the stock?
Yes, we have been positive even before once the merger was announced, and obviously, if you remember, Ambuja has been underappreciated in the market, so it always used to trade at a discount. But if you really look at the fundamentals, actually, there was really very difference between Shree and Ambuja, but at least there was a 25% valuation difference between Ambuja and Shree. So I think the issue was basically that the earlier management was not keen on growth. And once the new management is come in and they are known for growth, I think that's what people are betting on. The recent raise of money, basically, at the moment, I don't think so they require anything on a organic basis. So this must be something to do with the inorganic space. And Adani's are an ambitious group, and they wouldn't just wait at 70 million tons. So obviously, I think they must be looking to acquire something more, and I think that's what the money is for.
Right. Nishal, hi. Good morning. Are banks still good for more, in your opinion? You know, this overall chorus that of domestic demand holding up very well and earnings growth looking good. You know, it's got to show up in banking and financial services. Credit growth in any case has been picking up. The latest data also shows that. What do you like there?
Morning, Prashant. So I agree with your prognosis there. Basically, very clearly, I think banking space is one because of inflation also. So working capital requirements are there, and then there is strong underlying demand in the economy also. So I think both ways, plus clean balance sheets, very well capitalized balance sheets. So I think all these things are now kicking in for banks after almost a period of 5 years. Our top pick still remains to be the large caps out there. So ICICI, SBI, and HDFC in that order basically is what we like in banks.
Okay, all right. Well, let's move on then. Initial request you to hold on. We are inviting our first management on the show first. And that's on the theme that we've been discussing, the government's push towards defense Indianization. Today we speak about the company that is benefit supplier of the high precision components as well as subsystems. Mr. Reddy, the managing director at MTAR Technologies, joins us. Hi, Mr. Reddy. Thanks so much for joining in. Well, there's this big push that's being talked about. Are you seeing signs of it? Is it evident on the ground? And more importantly, I wanted to ask you that if this opportunity comes to you, what are the maximum peak revenue potential that you can achieve with your current investments? Go ahead.
One thing is the technology that is available with us. We are doing enough R&D to develop and indigenize the systems and various products for Government of India and the defense organizations across the board. Another very important issue is in order to become a defense prime with the latest technologies, a lot of MNCs, because of the Make in India concept, have to approach the companies which are capable in India to join them together to have a jump start in able to achieve this very quickly, which is also very important in order to ensure that we are on track with the indigenization program. So that will be a large benefit for a lot of companies which are capable to have a joint venture with the leading MNCs who are already in the defense sector big time.
Mr. Reddy, but if the opportunity comes to you, then what kind of peak revenues can you do? You've been talking about big growth numbers. I think for this year as well, you're talking about a 25-30% or more than that growth. So at peak levels, what revenue potential can you come up with?
No, it's too early to comment on the numbers, but our growth numbers are not linked to this, defense indigenization program. This is something which will be an added bonus for us, and we need to quantify the numbers. But it'll be huge for sure. There's no second thought about that.
Mr. Reddy, defense is about 20% of your business, right? Sales?
Yeah, it's less than 20%.
It's less than 20%. Just to push on that point, the focus on indigenization is, of course, there. Lately, we picked up, but this is again not confirmed. We had the management of Mazgaon Dock join us yesterday, and I asked them as well, and they said, well, they've heard of it, but they've not seen a direct circular or anything of that sort. That for emergency purchases, defense purchases, the armed forces have been authorized to buy equipment directly from local suppliers, not imports, up to a certain value order. I mean, do these kind of things, I mean, I don't know if you've heard of this. Is that a significant opportunity? Or for you, in the space that you are in, it's largely the big platforms, projects which will make all the difference?
Yeah, it is a significant opportunity, provided if you're able to deliver it, you're capable of doing it. We are right up there in terms of the technology as well. So obviously, yes, and there's going to be more and more push towards Make in India concept, and that's where the whole difference is coming across right now.
Sir, I wanted to talk a little bit about the clean energy business, which is 53% of your order book. Want to understand how are you enhancing your own manufacturing capabilities in the clean energy space in order to meet the export needs, which perhaps could go up, and what is the kind of growth that you're seeing in that vertical?
As I said earlier, we have already planned the expansion requirements for the kind of growth we're looking at for this year and as well as next year. But it is growing pretty rapidly, and we are proactively planning ahead of time in terms of our infrastructure and the requirements needed for that. We are well ahead in terms of what we can achieve in terms of the technology and the implementation programs for clean energy.
Can you give us some numbers, sir? In terms of revenues, I think at the end of FY22, you were sitting at about 200 crores by way of the clean energy vertical. What kind of sustainable growth do you see?
No, as I said, overall, we said 55 to 60% of revenue growth we'll have for this year, including all the segments, where 55% of that or 60% of that would be clean energy in terms of the overall numbers.
Okay, and a couple of more details then. Your margins for the first quarter were at around 27%, but you have indicated that scales up to around 30%. And also your working capital days, I think it was at around 250 days. Where do you see that number settling?
The working capital days, we are looking at reducing our inventory levels. We are more a little bit cautious about the supply chain issues, the COVID-related issues. Slowly, the things are settling down, but not as yet. But we are looking at less than 200 days by end of the year. And margins obviously will settle down at the level of 30% plus minus 100 basis points by end of the year.
Which is what your guidance has been at. Mr. Reddy, for the clean energy business, for Bloom, what are you making for them now? I mean, has the product offering itself expanded? You wanted to scale up to making electrolyzers, etc. Could you give us some sense where you are at?
Yeah, we are adding newer products. Obviously, electrolyzers, we are doing the batch production right now. So even the products which we are doing right now, we are adding one more new product called the latest version of the Yuma version, that hot boxes that we are doing right now. And also a lot of assemblies, key assemblies for them, new products for them. And we've added with a new facility in Adibatla, we're also doing their enclosures and a lot of sheet metal assemblies for them right now. So we have increased our wallet share because we have been qualified for a lot of these in the recent past, the last one quarter.
So you've increased your wallet share with Bloom, but are you looking for customer diversification as well? Any new customers on the anvil like Enercon or anyone else?
Yes, already we have orders from GE Renewable. We have orders from Voith, Andrix in the various other clean energy segments as well. And we are in discussion with Enercon, and that should get through. So we're adding a lot more customers, but please understand in fuel cell technology, the kind of volumes they need to achieve, and for MTAR to get involved with other customers in fuel cell, it could take time because they need to come to the level of Bloom in terms of the numbers, what we're looking at, for them to look at reliable OEM to work with them.
All right.
So that's where we stand.
All right. Thank you very much, Mr. Reddy. Appreciate you joining in and running us through all of that. It's good speaking with you, sir, and good to have you with us here on the program. So that's MTAR. Initial, of course, is still with us. MTAR is, of course, a smaller defense play. There are, more focused defense plays which have done extremely well. MTAR, not so much. Initial, I don't know if you have any views on this space. It's a large order ticket size segment, but that also makes it very lumpy and kind of difficult to project. Any thoughts here? And if you have coverage, what do you like in that space?
So my thought on that space is, yes, it is a very promising space given that government is very keen on indigenization. The only issue remains to be, I think I have said on your channel earlier also, basically because only 10% of the government's defense budget actually goes into the newer projects. Remaining almost 75% goes into the regular expenses of salary and upkeep of the troops and all. And another 15% is for the projects which are existing and because these are all multi-year projects. So the allocation to new projects is very small of the total budget. So when we look at a total budget, it may be a huge number, but what really comes to the new project is not very significant. So that's why it has to be a very calibrated thing. I don't think so most of these companies will be able to do more than 10-15% kind of a growth, because that's the kind of money allocation happens every year from the government for them.
Okay, welcome back. So the SGX is indicating a 280-odd point lower start. So a little bit of improvement from the time that we first looked at it at 8, but not by much. 1.5% lower, in line with what the rest of Asia is trading at. Overnight, of course, if you're just joining us, we saw very deep cuts. 5%, 4.5% and 5% cuts respectively on the S&P and the NASDAQ. So, in light of that, 1.5%, I think would be par for the course. Also, of course, with all the gains that we've had very recently. Let's set you up in terms of trades that you may want to take and how to approach the market. Mitesh Thakkar and Sudarshan Sukhani are joining us to help us do that. Gentlemen, great to have both of you here. Thank you very much. Sudarshan, to you first. We get that gap down, but what after that? What would you advise viewers to do?
Good morning, Prashant. See, we get that gap down. It's not a gap down. It's a monster gap down and supported by very weak global cues. So in such an environment, despite the fact that we are in a bull market, I would not trade at all today. It's not worth it because the gap down actually signifies increased volatility. Volatility means a random directionless market. It's better to step aside and then we'll wait for tomorrow to see how the stability comes in. That applies to the Nifty and the Bank Nifty both. I would not trade any of the indices today.
Okay, wouldn't trade any of the indices today. Better to be a bit cautious given the gap down. Got that. Mitesh Thakkar is also with us. Mitesh, good morning. Would you concur with that view that it's better to just step aside because of what's happening globally? And if we do stabilize and the dips do get bought, then what should be the trajectory for the day?
Good morning. So I think the start should be very similar. I think, once you open gap down, first thing is that you will possibly want to exit some of the longs which you're carrying. Secondly, you would want to see whether the gap down is getting bought into or not. The levels which I watch closely on the Nifty is 117,870 on this spot. If that breaks, then I think this correction could possibly extend about 17,500. So if 17,870, 850 holds, then you might want to explore some kind of buying, but you can only decide once the market is open and you've seen about 20-30 minutes of trading post that. So in that sense, I think the first idea would be to at least cut down your long exposure and see whether you want to add more at lower levels in case the Nifty is getting some kind of support post the gap down.
Okay, all right, Mitesh, morning. We've got that view. What about individual stocks?
Well, I've still kept a couple of buy calls in my list, some sells as well. So Coromandel is a sell with a stop at 1,048, targets of 1,005. Page Industries, if it breaks 48,000, and that could happen with the gap, sell with a stop at 48,400 for targets of 47,200. And on the buying side, our conditional buys, I've identified two stocks when the pattern is good, the structure is good, but if they start getting past yesterday's high, then buy. So IndusInd Bank, buy above 1165, keep a stop at 1149, look for targets of 1,200, and Power Grid is a buy about 227.5 with a stop at just below 225 for targets of 234.
And what about individual stocks? Sudarshan, what would your list be?
Yeah, Sorry, yes. See, Sonia, it's one of the rare days when I don't think I want to recommend any stocks for intraday trading. So, because it's the same story. We don't know where they will open, whether they will find support, whether they will find resistance. Nothing is we don't know anything about the market status at all. I have two stocks which I want to talk about. If you are a positional trader, if you are an investor, or even if you are a swing trader who's willing to carry positions for a few days, there are two stocks which can be used to buy for buying in this dip. The first is ICICI Bank. It's an outperformer. And I think if you accumulate or if you buy this dip, you'll end up with some money. It's not intraday at all. And the second is L&T, Larsen & Toubro, which has been an underperformer, but I think has better prospects.
All right. Thanks both of you, Sudarshan and Mitesh, and we'll lean on you later in the day to take us through the market, as it is going to be a tough day. I mean, no doubt about it. We'll take a very quick break here. We'll come back with the pre-open session. We also will be speaking with the management of Ami Organics, as promoters there have sold 2% of their holding. But some interesting investors have been on the other side, the people who've bought this stake. We'll talk with Naresh Patel, Executive CMD at Ami Organics, on the other side.